In the world of financial modeling, simplicity can sometimes be a weakness. Older models often assume that interest rate volatility is a fixed constant. But think about it. If we were in a period of hyperinflation, would you really expect interest rates to move with the same calm predictability as they do in a stable economy? Of course not. Furthermore, when rates are near zero, they hit a natural floor. They can't just keep falling into deep negative territory without friction. This means that as rates get lower, their volatility should naturally dampen. We need a model that acknowledges that the level of the rate itself changes how much that rate swings. To solve this, we turn to the Cox-Ingersoll-Ross, or CIR, model. This model introduces a more realistic way to look at rate changes. Its core innovation is making basis point volatility proportional to the square root of the current rate. Let's look at the formula. The first half of the equation handles mean reversion, which is the economic gravity pulling the rate back to a long-term target. But the second half is where the magic happens. By including the square root of the rate, the model ensures that as rates rise, volatility increases, but at a decreasing pace. Most importantly, as the rate approaches zero, the volatility also shrinks towards zero, effectively preventing interest rates from ever turning negative. Let's put this into practice with a monthly calculation. Imagine our current short-term rate is 3.00%, but we expect it to eventually settle at a long-term mean of 5.00%. We'll set our speed of adjustment at 0.20, a volatility factor of 1.20%, and a random market shock of 0.10. First, we calculate the drift, or the pull toward the mean, which gives us 0.0333%. Next, we calculate the stochastic, or random volatility component, which results in 0.0208%. When we combine them, we find the total rate change is 0.0541%. This means our new expected rate after 1 month is roughly 3.0541%. This step-by-step process shows exactly how the current rate level dictates the size of the next move. Finally, let's look at the long-term horizon. If we forecast where rates might be 10 years from now, the CIR model produces a very specific shape called a right-skewed distribution. Unlike a standard bell curve, which might incorrectly suggest a high probability of negative rates, the CIR distribution respects the zero boundary. It shows a long tail to the right, acknowledging that while rates can technically climb quite high, they are physically blocked from dropping below zero. For financial professionals, this isn't just a theory. It's a vital tool for accurately pricing complex options and understanding the true risks of the market.